Okay, so perhaps the most interesting part of this particular chapter is the actual preparation of an operating budget. And Learning Objective 3 walks us through this process. So as we saw in the previous lectures, there are some detailed budgets that make up the operating budget. We'll look at our anticipated sales, production, the cost of production, material, labor, and overhead, the costs that get moved to cost of goods sold once we've sold those products, and then our selling and administrative budgets. So once again, these are the components, and this is the order in which those components would be prepared for the operating budget. So your book tells you that you're going to begin with the end in mind, and so they have actually pulled some information from their December 31st, 2018 balance sheet. Now remember, we're going to begin the preparation of the 2019 budget before the year-end 2018 takes place. But we do need to be able to determine ending cash, ending accounts receivable, and inventory. So we'll have to use some estimates of what we think our beginning of the year numbers for 2019 are going to be. The end of 2018. These will become the beginning numbers for 2019 that will help us move our budget through to get ending numbers for our budget. Okay, just keep this in mind. The sales budget. Your text tells you that this is the cornerstone of the master budget. This is where our marketing people and our salespeople are crucial and critical to the success of the budget, because this is where we begin. And if sales increase, then production cost increase, administrative cost will increase. So what happens if we budget for sales that we can't generate? Okay, then the opposite is taking place, and we may not be profitable, and this could cause our organization to possibly go under. So we need salespeople and marketing people who can understand what the market can sustain and is willing to purchase from our organization, whether it's in products, services. Okay, so in this case, we're going to look at Smart Touch Learning throughout for this operating budget, and our salespeople have anticipated the number of units that they think we can sell, and they have estimated that we will sell 50 more units every quarter than we did the prior quarter. So once again, this first line is key to our entire budget. If this number is incorrect, the rest of our budget is incorrect. And so to show you how crucial this can be, one of my first jobs in public accounting was a situation where I was sent out to help a manufacturing organization to analyze a budget that had been prepared for them in Excel. And so this Excel budget probably contained 15 to 20 different worksheets. Okay, and the company had a couple of different products that they were selling in different regions with different salespeople. And so if you simply changed the number of salespeople from 5 to 6, then that changed the number of units that the organization would actually sell in that particular area or division. So once again, this was key to them because any change in sales impacted everything else in this organization's budget. Okay, so this needs to be as precise as it can possibly be. Estimate the number of units you think you're going to sell. What is your estimated sales price? And this generates our total sales. And in the end, these total sales will end up on our budgeted income statement. Right, once we know the number of items that we're going to sell, we will generate a production budget. Okay, and the production is not always the same amount as what we're going to sell. So for example, we start here with the budgeted tablets that we think we're going to sell in order to come up with the budgeted tablets that we need to produce. Okay, sold and produced here are two different numbers. Why is that? Unless we are a just-in-time manufacturing organization and everything we produce is sold at the end of the month, then we may have some desired units in ending inventory. So if we never want to let our ending inventory get completely empty, all right, then we need to know these are the budgeted sales for this period, but let's add to that any tablets that we want to leave in ending inventory. So these are the total tablets that I need to produce. If we are leaving items in ending inventory at the end of the month or the end of the quarter, then we're obviously going to have some left at the beginning of the quarter. So if I know what I need to sell plus what I want to leave in ending inventory, these are the total tablets that I need this period, but subtract from that any tablets that you already had in beginning inventory, and this is what I need to produce. And once I know what I need to produce, now I can begin to determine the cost of materials, labor, and overhead for these particular units. All right, get this formula in your mind. It's going to move with us throughout the rest of the semester. So let's see that production budget taking place. Now notice that we had anticipated sales of 500 units, but I'm only going to produce 410. 550, but I'm going to produce 560. Okay, so why are these numbers different? Because the text says that they always want to leave some ending inventory out there. And you can go back and look in your text for the details here. I think it said that they wanted to leave at least 20% of the next quarter's sales and ending inventory. So if I think I'm going to sell 20% if I'm going to sell 550 units next quarter, at least leave 20% of those in ending inventory. 20% times 550 should be 110. So if I know I'm going to sell 500 in the first quarter, add to that what you want to leave in ending inventory. I need at least 610 units. If I had 200 already in beginning inventory, then I only need to produce 410. And if you'll notice, everything that I leave in ending inventory at the end of one quarter ends up being beginning inventory in the next quarter. All right, so now that I know how many units I need to produce in each quarter, we will begin with the first cost of production, which is direct materials. So what did I tell you about that formula? It's going to move with us throughout the semester. So if I know the number of tablets that I need to produce, how much material do I need per unit? Okay, so your book goes right over the amount of materials that I need and simply takes you to the next step. What is the cost of materials per unit? And that's fine for what we will do in Principles of Accounting. Once you get, if you are an accounting major and you move into the next level of cost of accounting or our graduate accounting course in the MBA program, we will talk about how we determine the amount of materials that we need and then the cost of those materials. But here, the number of tablets we need to produce times the amount, the cost of the materials that we're going to use for each unit, and that is the amount of direct materials that I need for production. But once again, we may not want our raw materials ending inventory to ever reach the empty phase. We may always want some materials on hand, and you can look back in your book. I think they told you that we need at least 40% of the desired materials for the next quarter and ending inventory. So if we know the materials that we need for production, add to that any that we want to leave in ending inventory at the end of the period. Because if we run out of raw materials inventory, that stops our production process. So what do we need for production plus what do we want in ending inventory? These are the total direct materials that we need, but back out any raw materials that we already had in beginning inventory. Now I know the budgeted cost of direct materials for that particular quarter. Okay, so this is important to us in determining cost, but as we will see later as we begin in the financial budgets, even though this is the cost of materials, we may not actually spend this amount in cash. All right, we'll look at that in a later objective. So to give you an example of the direct materials budget, the budgeted tablets to be produced came from our production budget. So if we were using Excel, we would simply pull these numbers from that production budget. We know the cost of materials per unit, so we know what it would cost us in materials for everything that we need to produce, but add to that the value of any materials that we want to leave in ending inventory, subtract from that the value of materials that were already in beginning inventory, and these are the costs that I am going to have to spend or incur each quarter for the production of my Smart Touch Learning tablets. Okay, so once again, if I know this is just one part of the cost of my tablets, the direct materials. The next step would be the direct labor, which is a whole lot less complicated. We know the number of tablets that we need to produce. We know the number of direct labor hours that will be incurred as a result of these products. The indirect labor hours will go into manufacturing overhead, but the direct labor is what we're calculating here. Direct materials, then direct labor. So we know that it requires 3 hours per unit, and we've estimated that our direct labor cost is around $25 per hour, and so this generates for me the direct labor cost of the units that I am going to be producing this period. Once again, produced and sold are not the same, okay, based on beginning and ending inventory. But now I have my materials cost and I have my labor cost. The last thing that I need is manufacturing overhead. So if we can remember from our prior sessions, overhead is allocated using some type of predetermined overhead allocation rate. And how did we come up with that? Remember, and this is what we're doing in our budget right now. We're estimating what we think our total overhead costs are going to be, and then we divide that by some type of overhead allocation base or driver. And in this case, your book has decided that direct labor hours are your driver, and so they've estimated total overhead cost of $154,560. They've divided that by the number of direct labor hours that they think it's going to take for the number of products that we're going to produce to come up with an overhead rate. Now, the variable overhead rate, we've got two different kinds of overhead, variable overhead and then fixed overhead. Okay, so our budgeted variable overhead is simply the number of tablets that we're going to produce times our overhead rate. The budgeted fixed overhead, okay, depreciation, utilities, property taxes, it isn't going to change. $12,000 per quarter for the depreciation, $15,440 for the other, and so you can see that the total fixed overhead doesn't change from quarter to quarter. But our total manufacturing overhead for manufacturing costs will, because the more we produce, the more variable overhead we're going to have. All right, so now I know total direct material cost, total direct labor cost, and my total budgeted overhead. So now I can estimate what the cost of my inventory is going to be on my balance sheet, but what cost needs to move off of my balance sheet and over to my income statement once I sell these products. Okay, so your text assumes that Smart Touch Learning is using FIFO, first in, first out. So they did have some beginning inventory, 200 tablets. And those 200 tablets have a cost of $55,000. So when we sell, if we sell 300 tablets at the beginning of the year, first we're going to move the cost for these 200, the $55,000. And then we will begin to move the 300 from the first quarter, the 550 from the second, the 600 from the third, and the 650 for the fourth. So the cost for these tablets, and we have estimated total cost divided by total cost of production divided by the total number of tablets that we're going to produce to come up with $294 per tablet. And so then we can see as the cost of those items that we're manufacturing this year move out, if we sell everything that we think we're going to sell, our cost of goods sold would be $672,400. Okay, so those are our product cost, moving through the production of our product, through inventory on the balance sheet, all the way to cost of goods sold on the income statement. But what about our period expenses? So these are our selling administrative expenses that take place during the period and are immediately expensed on our income statement. And if you'll notice, we have variable and fixed selling and administrative expenses. Our only variable expense is supplies. How can we tell? Because every other cost stays the same each quarter. The supplies expense, your book says, were 10% of sales, I believe. Okay, so they are going to change every quarter. So now we have the budgeted selling and administrative expenses. So for my income statement, I have sales, I have cost of goods sold, and now I have my SG&A expense. So we are preparing the supporting tools that we need to begin our financial statement budget preparation, which is what we will look at when we come back in Objective 4.